And so that's how we build your portfolio based on that risk return. How much risk can you afford to take? And then we try to get you the maximum return that we can get for you based on that amount of risk.
Hey everybody, welcome to the Blue Collar Wealth Podcast. We call it that because this is a show about real finance for real people. We often get asked, what kind of clients do you work with at Stonehouse? And the term I like to use is blue collar wealth. Most of our clients have anywhere from $500,000 to several millions of dollars saved up in their retirement account, but they don't really care about buying a giant yacht and sailing to the south of France or something like that. Most of them really want just to know, how do I squeeze more juice out of my retirement and live a long, happy, healthy life? Well, my name is Bob Brown. I'm a certified financial planner and a founding partner here at Stonehouse Retirement Income Planners. I've had the privilege of helping many families plan and live their lives for over 20-some years now. I'm part of a growing team here at Stonehouse, and we've seen our clients go through a ton of different things in their lives. And now, thanks to the beauty of the podcast, we can share some of those stories and maybe even share some shortcuts for you to help you get on track or stay on track with your own finances. In this episode, we're going to talk about why that risk questionnaire actually matters. These days, whenever you work with a financial planner or advisor or some kind of broker, they usually ask you to complete a risk assessment, usually in the form of like a quiz or a questionnaire. So how much time do you actually spend on that questionnaire? And what is it really? And why does it matter to you? You're not alone in feeling a bit confused or maybe even by not realizing why those answers are important, but they are important. And we want you to pay attention to your answers. And by the end of this podcast, I hope that we're able to show you why it's an important part of the process, how to go through this step effectively, and why it's so important to keep it fresh and up to date. To help me discuss why that risk questionnaire actually matters, I brought in Scott Stone. He's one of my partners here at Stonehouse. Scott's also an advisor at Stonehouse, and he serves as our chief compliance officer as well. So he dives into this subject matter every day. All right, Scott, so when inside of Stonehouse, we have our own risk questionnaire. We have a process that we go through with people. You were a very big part of building that. Together we built that questionnaire, and we've tweaked it through the years to be more representative of, what people experience in today's world versus 20 years ago. But we do that for every client. Mm-hmm. So why is that so important for somebody to make sure that? Why is it important for an advisor first to have that on file and go through that with a client?
Yeah, it's a great question. So the risk questionnaire is a small handful of questions, 7 of them that we ask that help us better understand and form conversations around the investor's goals and their proclivities when it comes to their account going up and down. Because we're going to take their money and we're going to put it into a diversified portfolio. And that diversified portfolio is going to have things inside of it, securities like stocks and bonds, and the value of those investments are going to fluctuate up and, more importantly to this conversation, down. And so what the risk questionnaire does is, one, it helps the client sit down and take a minute to formulate how they will interact with risk as it comes in the future. And it allows the advisor to create a conversation around that, to coach the client in advance to say, these times are coming. You're going to have times when your account value goes down. How are you going to react to that? Because one of the most important things we can do as advisors is to keep clients consistently invested in a diversified portfolio for the long term of the investment. Most of what happens with clients who end up losing money in the stock market is that they turn those kind of short-term paper losses into realized permanent losses by selling out at the bottom. So they wait until the news comes on and says everyone's lost a ton of money, and then they panic and sell out of their portfolio and lock in those losses. And then the next news report comes out the next day and says, oh, things are looking brighter and the stock market recovers, but they missed that because they sold out at the bottom. And so we want to make sure we put our clients on a ride through the future that they can tolerate, because then they stay invested in the stock market. And so we don't want to expose our investors to more risk than they can emotionally handle. So we ask these questions at the beginning of the relationship and throughout the relationship, as you mentioned, maintaining, because people change as time goes on. So we'll ask them about their age, how long they plan to stay invested, what their investment goals are, what their expectations are for the type of return their portfolio is going to get, and then how well they sleep at night when the market's going up and down. And so with just a short handful of questions, because we don't want to be too hokey with it. We don't want to make it a 3-hour long process to get a personality profile for the client, because clients typically don't want to commit that much time to a process like that. So with a brief 7 questions, we're able to get a snapshot of how consistently you're going to be able to remain invested in the portfolio that we plan to put you in. And based on your mentality and your personal leanings, we can put you in a more conservative or more aggressive account based on your preferences. And those choices will have ramifications on your financial plan. And
Sure.
so we'll reflect that in your financial plan. If you need to be a very conservative investor, right now conservative investments don't pay very much. We're in a very low interest rate environment, and there's not much interest being paid on those more stable investment types. And so that's going to decrease significantly your long-term return, which is going to decrease the amount of money that you can take in your retirement income streams, as an example. And so we can take your preferences on the Risk Tolerance Questionnaire and update your financial plan to say, oh yeah, they're, instead of maybe going after a 6% return, we're going to put them in a portfolio that targets maybe a 3% return. And as a consequence, they're going to generate half as much money over the long term, roughly, and so they can take half as much in retirement income because of those decisions.
Yeah. And I might be one of the few people, I love talking about the Risk Tolerance Questionnaire, what we call it, just because I think it helps frame that conversation out. And I'm a metaphorical person, so I like ours because we don't just say, so are you okay with a 20% loss? Because a lot of people can't really frame that out in their mind. What does that mean? Sure, right?
Right.
But instead we say, like, if you invested $100,000 today, and a year from now I tell you it's 80,000, are you okay with that?
Right.
And usually they get it. You either get yes, I'm okay with that, I understand, or they get oh no, even though they said yes to the question at 20%.
Yeah.
People don't necessarily equate the percentage to the dollars.
They
right?
don't go through life equating percentages in their mind usually. So it's usually it's dollars. It's I have $10, I have $20, and they think in that terms.
Yeah, and a good questionnaire, like I think ours is, and anyone that walks through this with wherever they're going for that advice, it should be a conversation starter, right? It should open up some very good, important topics that you should be discussing with whoever's going to help you invest your money.
Because sometimes there's mismatches. So you might have someone that has an expectation of very high growth. They want their money to double in 5 years. But then you ask them that question, if you had $100,000 and went down to 80, would you be comfortable? They're like, oh, no, you better, no, I can't lose money. And so you have a mismatch there, because they're not going to be able to get fast growth without taking on that potential of loss.
Right.
And so going over that risk-return relationship with them, historically throughout history in the United States, particularly in the U.S. stock markets, there's been a reward for taking larger short-term risk. If you're willing to take the risk of your money going down more in the short term before it rebounds, typically the stock market has rewarded you with a higher average return over the long term. And so based on that, we create these models that help us hopefully in the future continue that and generate a higher return by taking on some more short-term risk. And so that's how we build your portfolio based on that risk return. How much risk can you afford to take? And then we try to get you the maximum return that we can get for you based on that amount of risk.
And I like the reference to that you said earlier, that keep it fresh, right? Because people change over time. And so I'm going to give, in my metaphorical way, I'm going to give the story. So I always, you've been with me on meetings with clients where we describe it as an amusement park, like the S&P 500. Investing in stocks in general is a roller coaster ride at times. There's just no way around that. And it's a question of how much can you stomach?
Yeah.
And I always suggest to somebody, when they go to the amusement park, they look at the nastiest roller coaster and they say, I can do that. If you get on that and you decide in the middle of that ride, it's not a good thing for me, you got to ride it out. You have to wait until it settles down, then you get off. Getting out in the middle of the first head wall is not going to be a good idea.
An important aspect of that is in a diversified portfolio, because in a well-constructed portfolio. So you can't just take your money and throw it all in a tech stock and leave it there forever, because any individual stock has a significant amount of additional risk and can actually go out of business. But with a well-diversified, planned-out portfolio, you have a very, very, very good chance of getting a nice long-term return in a well-diversified portfolio. There are no guarantees in the world, particularly in the securities industry, but for the most part, a well-diversified portfolio over the long term has played out very, very well throughout the entire history of the stock market.
Yeah, but people's in people's tolerance, I was going to say appetite, but really tolerance for that ride, the ups and the downs will change over time. It's just inevitable. And again, my horrible analogy is having just come from a trip to Universal and with my family and riding the same roller coasters that I rode 10, 12 years ago, to get on the Hulk.
Oh, yeah.
And have my brains feel like they're going to fall out of my skull. It was not a pretty sight. Like I'm not the same person I was when I was there last time. So I looked at the next roller coaster of similar size and I thought, you know what? I'm not getting on that one. I'll stick to the medium rides. And I hate to say that out loud, but it's the consequence of turning 50, I guess.
Oh, sure, yeah.
But that same appetite for risk typically happens with clients. As they get older, they want less risk in their life, and we're guaranteed things like that. So that has to be adjusted. It first has to get represented in their risk tolerance, right?
Yeah, right.
And so at least every couple of years, you should be updating that.
Yeah. Each time you meet with your advisor, it's not a bad idea to just kind of dust it off and check. But yeah, we have systems in place to make sure it's updated at least every 3 years is what we recommend, just to make sure that how we're investing your money is still consistent with your life. But and also each of our quarterly statements that we send out to clients has a request in there saying if there's any significant updates to your life, you've births, deaths, divorces, marriages, change of jobs, change of financial situation, let us know, because that might affect how we're managing your money. And so if you don't tell us, we're not going to know those things.
That's right. All right. Well, thank you very much for this. This is important. And as your life changes, you need to keep in touch with your advisor if you're using one, and make sure he or she knows what's going on in your life. If you want advice on riding large roller coasters, you got to go somewhere else. I'm not your guy. So thanks for joining us. Hope this was helpful, and we'll see you on the next one.